So let me just give a few words about myself before going into the core content of the today's webinars. As you know, or perhaps if you don't know, I became a MAX instructor in 2009 after, unfortunately, Jim passed away. Dr. James Pruitt, who is the inventor, the creator of the MAX trading system, and so I was a part-time trader at that moment, and I became a full-time trader in the Forex market in 2009. So a little after I began to before I began to teach the MAX. I am a past software engineer. I was a service manager, and I have practiced that career for around 30 years, 29 years exactly, and the last 15 years of my IT activity was in the banking industry in Europe, in some countries of Europe, France, Switzerland, Germany, Belgium, UK, and this has given me the opportunity to be in contact with some bank traders, and so to observe their trading attitude or the way they handle position in the market. But I am interested in trading and investing for many, many more years. In fact, almost 40 years now. And I have investigated many of these markets, so the Forex market, the futures market, the stock market, the options market. There is one market I have never considered for the moment, which is the bonds market, which is also a very interesting bonds market. No, Carlos, I'm not Portuguese. I am Belgian with some Italian origins, and so, but I don't speak Italian. So I was born in Belgium. I live in Belgium, and I live in France for 65, 66 years now. So this is for me. Now let's go into the MAX trading system itself. And so you could ask, what are the type of trader which could be interested by the MAX trading system? And in fact, the MAX trading system is appropriate for any kind of trader. You may be an experienced trader looking for some consistency in your results or in your trading process. I believe much more in the consistency in the trading process that than in the way to generate profit, because if you are consistent in the trading activity, in the trading process, the profit normally should follow. If you are a full-time trader wanting to diversify your types of profit, then the MAX is certainly for you. But it's also appropriate if you are a new trader struggling to become profitable, or if you need a very reliable and flexible trading system. So, and if you want to work from home, the MAX is appropriate, because what you need, after all, is just a PC or a laptop and an internet connection, and then you can have access to many, many markets to trade for. If you plan for retirement, if you plan for extra income, whatever the reason you have for this extra income, then the MAX is certainly for you. And the MAX has been developed many years ago, so by late Dr. James Pruitt, known as Tiger by his student, and he began to teach the MAX in 2007. And then his idea was to develop a trend-following system, because trend trading has been proved for decades and decades to be the best approach in trading. And so the MAX is a trend-following method, essentially a trend-following method, which can be adapted to some other styles of trading. But the MAX is an abbreviation, an acronym for three important concepts in this trading system. The M stands for momentum. We want indeed to see enough momentum and volatility when we want to take a position in the market, because momentum and volatility are created by some types of order, by some types of actors in the market. And then the A stands for acceleration. This does not mean an acceleration in the price action itself, but an acceleration in the way to generate profits from the trend we are trading. And this means, how can we progressively add to an open position to build a larger position while controlling the risk on this growing position in order to accelerate the profit we can extract from that trend. And the X stands for exit, because at some point along the trade we will have to make partial exit until a final exit when we will have to close the remaining opened position. So I have mentioned a very important word, risk, trade risk management. So the MAX is associated with a very strict risk management system and money management system. Both are important pillars, as I will explain in a moment, to any trading system. And as Craig has mentioned, so the MAX apply to any time frame and to any market, because any actors influencing the market trade all the time frames, in fact, and sometimes even no time frame at all. And so in order to show you the power of the MAX, and before that, I would like to show you three tips, or to teach you 3 tips you can use immediately in your own trading system if you have one for the moment. And these tips will immediately increase your profits from your trade. And these 3 tips are the following. The concept of divergence. So how can we use a divergence in order to either reduce the risk in an open position or to bank some profit, reducing also the risk on the remaining position? What is a good way to exploit long bars or long candle on a chart? And how can we consider risk reduction when we are handling a position? The concept of divergence is known by many traders, if not all traders. If you have some technical analysis knowledge, you should know what a divergence is. It's when the price and some momentum oscillator behaves in a different direction, in opposite direction. But we never consider a technical analysis approach as a way to predict what the price will do, because we consider that even if we may have sometimes, and even often, very often, an idea of the direction the price will take, we can never predict exactly what the price will do a few minutes later, a few seconds later, a few minutes later, sometimes even a few hours later. But technical analysis helps to understand what the price is doing now and what the price has made in a recent past. And so we never consider technique with an indicator as a predicting method, but as a way to handle a risk. And I will explain that a little more in detail. But what is a divergence? When we are in a down movement, like on this example, on this chart example, which by the way was the euro card, the pair is not important itself, the time frame is not important, the moment of the trade is not important. What is important is the concept. So we were in a downtrend, and we observed two successive lows in the price. We have a first low in this area, we have a second low in this area, followed by another one, 1 bar later, 2 or 3 bars later. But at the same time that we were seeing lower lows in the price, we were seeing higher lows in this momentum oscillator. The momentum oscillator is not important by itself. You can use any one you want. In the MAX, we use the stochastic of the RSI oscillator, which is not too reactive, which is not too slow. It's exactly perfect. It has the perfect behavior for the aim we want in using such kind of indicator. And so when we see in a downtrend lower lows in the price and higher lows in a momentum oscillator, we say that we have a divergence. And this divergence does not imply automatically an exit, whether it is a partial exit or a total exit. But it indicates that something is happening which can increase the risk we are in the trade. And when we have such a divergence, at the close of this first blue bar I'm showing on the chart, we have to define an exit level. Of course, in the macro trading system course, we explain exactly how to choose that exit level. And when the price hit that exit level, then we make a partial exit. Sometimes we will have to make a total exit. And so this means that we are using an indicator as a way to quantify when a risk is appearing in the trade, and we want to limit that risk. Because indeed, what is a risk fundamentally. When we see the price at some point moving in our favor, we are making some profit, but this profit is a potential profit, and the profit is a concrete profit when we close the trade. But if the price begins to start a pullback, then the consequence of that pullback will be a portion of the partial profit we were making is disappearing. And at some point, we have to take the decision to reduce that risk. So in order to keep a portion of the profit as large as possible. And this is the aim of our exit technique. A divergence in the max trading system is an exit technique. And so when you see such a divergence, you can take the decision to make at least a partial exit, banking some profits in this case. Later on, we had another divergence because we see again lower lows in the price, successive lower lows, and higher lows in the oscillator. And so we have another exit setup with this blue candle. We define an exit level, and if the price follows through and hit that exit level, we make another partial exit or total exit if the exit setup is an important one. And so I show a third example. So here with, again, two lower lows in the price and two higher lows in the oscillator. So, and so when we are banking some profit, in fact, we are also reducing the position, the remaining position we are handling, and so we reduce the risk. We reduce the risk not only by reducing the position size, but also by banking some profit. You can observe in this example that if my stop loss is, in this example, 22 pips, if I bank a partial profit of 13 pips and a partial profit of 15 pips, this represents 28 pips. So this will balance a large portion of my initial risk of 22 pips. So not all the risk, of course, it depends on the size of the movement in this trend, but there will be another mechanism we can use to reduce the risk I will mention in a moment. By the way, in this example, so this trade has produced a profit of total profit of 27 pips when we add all the pips being banked, but this is not the real profit. The real profit can be measured as the reward to risk ratio, the realized reward to risk ratio, which in this case was 1.02 R. I like to use the Van Tarp notation, where R represents the risk we take in terms of a percentage of the trading account or in terms of money. For example, if you decide that the risk is 2% of your trading account, then on this trade you would have made 2% times 1.02 or 2.04% profit. Another way to express the reward to risk ratio is if you risk $100 on this trade, your profit when the trade is closed is $102. So similarly, in an uptrend for a divergence, we will compare the successive higher highs in the price with the successive lower highs in the corresponding oscillator. And whenever a divergence has been pinpointed, again, we define an exit level, and if the price follows through, we make a partial exit. Of course, it is possible that the price does not follow through enough, in which case the price will not reach our exit level. In this case, we don't make the partial exit. We keep the position entirely opened as initially. And this is why we never use such an indicator as a predictive way, but as a risk management, a trade risk management. You see also on this chart a second feature, these white lines which trail the price movement and which represent effectively a stop loss adjustment. Our initial stop loss in this trade was 28 pips. Of course, in the macro trading system, we explain how to define our stop loss for each trade. There are many techniques we can use, and I am convinced that you know several such techniques to fix your initial stop loss. And at some point, we have to adjust our stop loss in order to reduce the risk on the remaining position, and sometimes to make even the trade a risk-free trade. In this example, we can see that after the initial entry, the stop loss has been adjusted the first time or the second time after the divergence. With the divergence, the trade has made a 49 pips profit. or at least a partial exit, and the stop loss adjustment is such that the stop loss is approximately at the same level as the entry. This means that for the remaining position, the trade becomes risk-free. It is not only a risk-free trade, but it is also a guaranteed profitable trade because we have banked an initial profit on a portion of the trade, but for the remaining position, so it becomes a risk-free trade. And this profit we are looking with the first partial exit will become larger and larger in the future with further stop loss adjustment and with further partial profit using the same technique I have described previously with the divergence. So the combination of making partial profit on exit technique, for example, a divergence and a stop loss adjustment is a combination very, very powerful to handle the trade risk or to handle the risk on the trade. The aim of a max trader is to, first of all, assess the risk we take on the trade, but then to handle the risk, to control the risk, reducing progressively that risk with a stop loss adjustment, but also with a partial profit taking until we get risk-free or a guaranteed profitable trade. Once we are in a risk-free trade, then we can consider how to optimize the profit we can extract from the trade. And this is explained in detail in the max trading system. The third tip we can use, or you can also use in your present trading system, is the exit technique using long bar. What is a long bar? Generally speaking, a long bar will be obvious on a chart. When you see a price movement and you see such a candle, a very long candle, so this long candle may indicate either stronger momentum, but it can also indicate some weakness in the market. The problem we have in the Forex market is we don't know the total volume of activity in the market. We have only the tick volume of the broker with who we are trading. And so a long bar always represents, consequently, a risk in the trade, because if it represents a weakness in the market, this long bar will be followed by a pullback. And this happens approximately 2 out of 3 times. 2 out of 3 times we will see a pullback, and this pullback may be a small pullback. It may be like this one, we have a small pullback here. It may be a larger pullback, and sometimes it may be also a trend reversal. And so a long bar, 2 out of 3 times, will represent a risk. And so a long bar is always a good opportunity to bank some profit when the price indeed initiates some retracement. And the way to catch some profit along that retracement is to use a portion of the size of the long bar as our exit limit, in such a way that if the price retraces and hit that exit level, so we make a partial exit. So in terms of proportions of the long bar, you can use 1/4, 1/3, 1/2 of the size of the long bar to help to define your exit level. Now the question is, what is a long bar? So visually, most of the time a long bar is obvious, but sometimes it may be difficult to define if a long bar is, or if a candle is a long bar or not. And so we have defined a rule in the max trading system which consists in telling a long bar has a size which is at least 2 times or more than the average length of the previous candles. And so 2 times is the minimum size to have a large bar, a long bar, but it may be more than 2 times, especially when we have some reason we don't know in the market to see such an acceleration in the price movement itself. And so sometimes the price will indeed retrace 2 out of 3 times, and sometimes it will not retrace, in which case we make no partial exit. And so if you apply that technique alone, so considering to make a partial exit whenever you see a long bar and the price begin to retrace, so you will immediately catch a nice profit due to the nature of the long bar. And if you associate that profit taking with a stop loss adjustment, so very often your trade will become a risk-free trade. So, and depending on the size of your trade, you will have a lot of flexibility to handle the rest of your position. So the divergent technique, the long bar technique, and the stop loss adjustment technique constitute a very, very powerful combination for a trade risk management, a very powerful trade risk management, so to handle your trade in order to make your trade risk-free as soon as possible. So not necessarily immediately, it depends when all these techniques will apply, but whenever they will apply, so they will make your trade much more comfortable. Because the problem is the psychological aspect of trading. So everything is fine when the price is moving in our direction, but how do we react when the price begins to make a pullback? Because we never know in advance how far the pullback will be. And at some point, the pullback will be a trend reversal. So in this case, if we don't take some appropriate action, all the potential profit we were making can completely disappear. And I'm sure that you have already experienced such kind of situations. And this is not a situation which is an obligation. We can avoid this obligation by an appropriate trade risk management. So this is for the three techniques. So try this technique and you will see your results improving immediately. Now, I think it's a good time to start with the max trading itself. And so when we have to define a trading system, I consider that we have to base the trading system on 5 pillars, minimum 5 pillars. The trading strategy itself, what are our entry setup, exit setup, how do we adjust the stop loss, what are the patterns we are interested in. We have also the trade risk and the money management I have explained previously. How do we control the risk? How do we control our drawdown? How do we control the growth of our trading account? And so all these are the content of the trade risk and money management. But another important pillar is also the global context analysis. You observe every day that the price movement in the market are not random. They are driven by a lot of factors. A good example is what has happened yesterday. You know that for the moment we have the Jackson Hole Symposium, which is that meeting every year with central bankers. And so this symposium is made with around 50 central bankers. And if you have carefully watched and listened the speech by Powell yesterday, a few minutes later, the market has reacted to his speech. His speech has not been very hawkish, very dovish, and so we have seen the US dollar strengthening, and so we have seen also the stock market plummeting, a big sell-off in the market. And so we can understand that when we understand these kind of driving factors, the price movements are not random. The mindset is also important, which is the psychological aspect of trading. When we define a set of concepts and rules, we have to stick to these rules because we need to have confidence in what is happening and not to change our trading process because we get one losing trade. We will always have losing trades, but the problem is not to have losing trade. The problem is to be globally profitable. And also a very important point, the organization. How do we organize ourselves? How do we organize our trading activities in relationship with all the other activities in our life, professional or personal life, in order to have a worthwhile trading process? So, and the Max, in fact, combine these concepts. Let me explain some of these concepts. First of all, we have to define in terms of strategy what is a trend. And there are many ways to define a trend. We can use a very classical approach like higher highs, higher lows, or lower highs, lower lows. We can use moving averages to define a trend. They may be simple moving average, exponential moving average, whatever the moving average you want. But we can also use the behavior of higher time frames. And we define the trend and the movement inside the trend in the following way in the Max. We have an indicator. Instead of using a moving average, we use another type of indicator, which is called we will call the companion indicator, and the companion indicator gives the technical directional bias of the trades of the market or the instrument we are trading. And we have two companion indicators, a slow bias, which is this green and red line, and the fast bias, which is this orange and blue line. And when the slow bias is green, we take only long trades. And when the slow bias is red, we take only short trades. Of course, this ignores for the moment the global context. The global context will give us the fundamental movement, the movement which are really worthwhile to be taken. For example, if the global context tells us to go long, this is what is indicated here, the max bias, the global context analysis was telling us to go long, and so we will take only the long trade when the slow bias will be green. And inside this trend, we have these two lines, yellow and orange, which will describe the different movement inside this uptrend. And we will use them, in fact, to define our entry setup. And so what is an entry setup? An entry setup is a specific price pattern the price is exhibiting, and the price can exhibit several types of patterns to define an entry setup, and in the Max we teach all of them. Here the pattern is called the S&P MO. S&P means safe and perfect, and MO means momentum entry. So this pattern is a safe and perfect momentum entry. Once we get a valid entry setup in agreement with the global context bias and the slow bias, we define an entry level, we define an initial stop loss. The stop loss always controls the risk on the trade. And then once we see the price hitting our entry level, we consider the trade is made of 2 units. The position 1000 concept we teach in the macro trading system course will explain how to calculate the size of these 2 units in such a way that at some point we will have an exit setup. And an exit setup is defined in different way. We have exit setup based on indicators like the RSI or like some moving averages. This is an example of a long-term moving average we call the home base, and it's home base channel. The home base, it's the middle line. The home base channel are the 2 lines surrounding the home base. We have several types of indicators, so giving several exit setups. We have also exit setups based on pure price action. The long bar exit technique is such an exit setup, but we have other price pattern which will tell us that it's a good time to take some profit. For example, here we have in this area a nice pattern telling us to take at least some partial profit, and these setups of course are explained in the course. We have exit setup based also on some critical time period, like the news releases, for example, like specific time period inside a day trading, so inside a day for day trading. And so we have several types of exit setup, and when we combine all of them, so we have strategies to make our exit in such a way that when one of these exit setup triggers and the price follows through hitting our exit level, so we make a partial exit we will call an MX. MX stands for momentum exit. And when we have such a momentum exit, we will close 1 unit. Remember, I have said that when we open a trade, we open 2 units, but when we have a momentum exit, so we close 1 unit and we adjust our stop loss. You can imagine that in this case, with this first MX producing a profit of 50 pips, and if we adjust the stop loss, for example, somewhere in this area, the remaining position is completely risk-free. And we have even a guaranteed profit, because not only we have banked a profit on the first unit, but the second unit now has a stop loss which is higher than the entry level. So we have a locked profit on the second unit. And later on, when we get another exit setup, so we close the second unit. And to close the second unit, we have several techniques. We can close the second unit on the next exit setup, or we can decide to try to stay in this trade in this trend as much as possible until we have the trend reversal. And when we have the trend reversal or some other long-term exit technique, so we can decide to make our final exit. We have several types of long-term exit techniques. So the trend reversal, the trend exhaustion, which is not exactly the same thing, and the movement invalidation, which is another type of behavior in the price action. So just for the sake of the example here on this long trade, this trade which has been made so a few days ago has made a total profit of 139 pips, and because of an initial stop loss we call an ESL, emergency stop loss, so the size of this ESL was 17 pips, so we have consequently a reward to risk ratio of plus 4.09 R. How do we get that reward to risk ratio? We take the total number of pips made by all the units we have used in the trade. We divide by 2 because we have 2 units, and then we divide by the size of the stop loss. And this gives us the reward to risk ratio, the realized reward to risk ratio. Now, this is an example of trade made with our basic market trading system approach, which is called the max primer. One initial entry, possibly one partial exit, and then the final exit. But of course, we have a more sophisticated approach, which is called the max standard, which is our flagship course, which exploit another very powerful technique in trading, which is the scaling technique. And this is how this same movement has been traded with the max standard level. So we are again looking for a long trade. We had the same, we had a different entry setup. And then you can observe that along this trade, we have made a partial exit with our MX number 1, later a partial exit with the MX number 2, a partial exit with the MX number 3, MX number 4, and then our final exit we name XXX. If we use a 2 unit for our initial entry, how can we close 1 unit with these 4 partial exits? It's because in the meantime, with precise condition, we can add to the trade, and the add to the trade are called scalings. And so whenever we have the appropriate conditions to make a scaling, and we have very strict conditions to make scaling in order to control the risk on the growing position, so we add 2 units. And so when we make the scaling number 2, we have 3 open units at that moment. Why 3? We have opened 2 units with our initial entry, but we have made 1 partial exit, closing 1 unit. So we were left with 1 unit at that moment. If we add 2 units with the scaling number 1, we are left now with 3 open units. And then we make an MX2, closing the second unit of the first entry. Then we make a scaling 2, MX3, MX4. And so when we are at the XXX, when we have to close the entire position, we have opened 1, 2, 3 positions representing 6 units, but we have closed only 4 units with our MX from 1 to 4. And so when we have to close our position, so we have to close the 2 remaining opened positions. And of course, when we make such kind of scaling, we introduce a new risk in the trade. And this is where the trade risk management with the banking profit I have explained previously with the divergence, for example, with the long bar technique and with the surplus adjustment will play an important role to keep the risk under control at an acceptable level for the trader. And when we consider that a trade which was an ordinary trade, it was not an exceptional trade, it was an average trade with only 3 scalings, 4 partial exit and the final exit. So the total profit made on this trade has been 326 pips, which seems a lot, but as always, the number of pips is never the real measure of the trade efficiency. It's the reward to risk ratio, which is extremely important. Here we had a reward to risk ratio of plus 10.87 R. This represents a profit of more than 20% with a risk of 2%, or $1,000 if you take a risk of $100, for example. And if you compare that result with the same trade made by the max primer, you can see that in terms of pips, we have made almost 3 times more pips, and in terms of reward to risk ratio, more than 2 times the reward to risk ratio of the max primer. And so the scaling technique with its scale out technique through the MX so provide a very, very powerful technique if the risk is controlled to make nice result. And you could argue, yes, but this was an exceptional movement that day. But we will teach you how to catch these movements almost every day. So because such a movement is called, in our terminology, a true trend, and for almost all the pairs you can trade in the Forex market, at least with the 8 main currencies, because there was also a problem of liquidity, such a true trend happened between 2 and 4 times per week on average. So why is risk ratio 10.87 rather than 20 times the stop loss of 15 pips? You have, as I explained previously, done. So when you add all the profits made by the individual units, so 18 pips for the first unit, 56 pips for the second unit, 63 for the third unit, 87 for the fourth unit, and 2 times 51 for the 2 last unit, you add all of them, you get 326 pips. But you have to divide by 2 because each entry is made of 2 units and you close each unit individually. And so the real result is simply the average of this total number. If you use a 2 units approach, you have to divide by 2. If you use a 3 units approach, you have to divide by 3. If you use a n unit approach, you have to divide by n. And it's only that divided number that you divide by 15 in order to get the reward to risk ratio, the real reward to risk ratio. This means that if you risk $100 on this trade, at the end of the trade, you would make $1,000 and not $2,000 because each unit contributes only for a portion of the profit. Okay? Is this okay? So time, you multiply the stop loss size by 2 if you use a 2 unit approach. You divide by 3 times the stop loss if you use a 3 unit approach. Okay? Okay, no problem. You're welcome. So this was an example of a long trade in the futures market, in the Forex market. But as Craig has mentioned previously, we can use any other pairs, any other instrument. And in this example, I will show you the pound US dollar. Here the pound US dollar was a short trade. With the max primer, we had an opportunity to make 2 trades with an initial entry, partial exit, final exit, second trade, initial entry, a partial exit, final exit. And so you see the result here. So 2.9 hours in the first trade, 0.383 hours in the second trade, and so a total of 3.73 hours for the 2 trades. With the max standard, when we allow for the scaling technique, so this down movement has given only 1 trade with an initial entry and several scale-ins, entry number 2, entry number 3, number 4, and several scale-out, exit number 1, so in this area, exit number 2, exit number 3, and so on. And so giving in total 279 pips with a stop loss of 15 pips. It's the same stop loss size as previously, but this is a coincidence. We don't have a fixed stop loss size of 15 pips. It depends on what the chart is telling us. And so showing a 9.3 hours reward to risk ratio to be compared with the 3.7 hour of the max primer. So that's strange. This is not exactly the PDF I wanted to show you because I don't recognize all the examples I wanted to show you. I think, Craig, when you have updated your chart, your portion of the PDF, so you have not taken exactly the one I have sent to you, but that's not a problem. So I will show later an example in the futures market. So here we have gold, which is a commodity. So gold, you can trade in the futures market with NinjaTrader, for example. And indeed, we have also, despite the fact that I'm showing MetaTrader for a chart, we have also the market trading system for NinjaTrader. So, and here, so it's gold, and the buyers was telling us to trade gold long, and so here we have our initial entry, followed by a partial exit and then the final exit, with a first trade making a 1.2 to 1 profit, followed immediately by a second trade with the same structure, so initial entry, partial exit, and then the final exit showing a second winning trade. So with a 2.9 to 1 reward to risk ratio, giving a total of 4.1 to 1 reward to risk ratio, or R. When I use the R notation, which is the Von Tarp notation, this is exactly similar to the 2-1 notation. So with the max standard, so we have something a bit different. We have scale in and scale out, scale in entries with an additional entry number 2, additional entry number 3, number 4, and then different scale out with just one trade, but now with a total reward to risk ratio of 12.8 R or 12.8 to 1, which is 3 times the profit made by the max primer. And so you can see that the scaling technique alone, when it is handled properly, so will multiply the profit in a big amount compared to the max primer. So,
hey, Eusebio.
Yes, Chris, please.
Hi, everybody. I'm Chris, Craig and Eusebio's partner. I've got your presentation up, and I can display it on the. I can display it for you if you wanted to switch over to my screen.
No, there will no point because the rest of the PDF has not changed. I can simply show the chart I have prepared. So here, so let me show you.
Sure. Okay.
Let's see here.
So, while you say this, thanks everybody for attending to this session.
No, I don't have them here, but I will show on the MetaTrader platform in a moment. So, what are your 2 moving average? Joseph, the moving average we are using, it's not important at all. We have this blue moving average we call our home base. And it's home base channel. It is a long-term moving average. It is a 233 moving average. And then we have a small short-term moving average here, the dotted line, which is a 21 moving average, exponential moving average, which is called the MO line, momentum line. And we have these 2 lines, yellow and orange, which are called the ETF lines, which are a custom indicator in the MAX. You will not find them. It is not a standard moving average, so it is an indicator we have built intentionally and specifically for the trade, for the market trading system. Okay, and so it is called the ETF lines. So you have seen that, in fact, if I come back on this chart, so we trade trends and we define the trends in a technical way by our slow bias until we have a trend reversal, and we take only either the long trade or the short trade depending on the global context, what the global context analysis tells us to trade. And we'll talk about the context in a moment. And so in this case, this means that if we had to trade long gold, we will take only the long trade and we will skip any short trade given by the market trading system. Okay? Well, Vin, can you show last week and go over the... Yeah, I will show in a moment in the MetaTrader platform. So keep your question in mind, and if I forget, so remind me that one, because it is really an interesting question, and this is an exercise we have made in our mentorship session during the weekend. We call our scrolling parties. So you have seen that the Max courses provide, in fact, trading methods which are very powerful, flexible and powerful, because they are based on concepts that work. And during the course, we explain what are these concepts and why they work in relationship with the way the big boys are making the market. Because we have never to forget that it is the big boys, either with their own position or with their algorithmic approach, that creates the market. The retail traders count only for a small portion of the actors in the market, less than 10% of the activity in the market. And so each course we have provides the training, of course. We explain all the concepts, all the rules, all the tools we are using, and support in order to reinforce your trading skills, to learn these trading skills and to develop these trading skills, and the risk and money management, which always constitute an important part of any trading system. You may have the best trading system, but if you have a bad trade risk management and a bad money management, your trading system will also fail. And so the Max course also gives you the confidence in your skills. Why? Because the aim of the Max is to help you to build several levels of confidence, not only confidence in the market. If you scroll through chart, you will see that the market will give you opportunity almost every day, if not every day. You will build also confidence in the Max itself, because you will see that the Max will help you to catch many of these opportunities, and confidence in yourself, in your own ability to apply the rules correctly. And Chris will explain a little more how this can be made through the homework and the free workshop we call the scrolling party we have every Saturday or Sunday when we make such a presentation like today. And so we provide you with 2 of our 4 courses, because we have in total 4 courses, but the 2 courses we propose you today is the Max Primer course, which is simplified or a sample of the Max Standard course, and the Max Standard course, which is our flagship training, which contains all the important concept and technique, especially with the scaling technique. So now, in order to help our members to better handle their trades, we provide lots of information about the global context, to understand the global context, because this really is important, and you will see the positive impact of understanding the global context in our trading. And the global context is a combination of geopolitical events, news releases, and the central bank decision. So you have seen yesterday with the speech by Powell and the future decision the Fed will take, how this has impacted the US dollar yesterday and the stock market, for example. But so we provide on our website, we have a specific page we call the news watch list, and Craig or Chris will put the link in the chat area of GoToWebinar, because this page is freely available to everyone, whether you are a Max member or not. So we provide a list of geopolitical situations we have to pay attention and to see how they evolve over time, because their evolution, positive or negative, have an impact in the market. We are seeing what is happening nowadays, so with the situation about the COVID, for example, about the situation in Ukraine, whatever the reason. Okay, we are not here to estimate if a reason is good or not, but we try to analyze their consequences in the market. So the decision of the Federal Reserve in USA. And then we provide also a simplified news calendar, because if you observe any economic calendar in Forex Factory, FX Street, my FX book, and so on, you will have a lot of news every day, and someday many news, even up to 100 news per day. But most of the news have no impact in the market, at least in the Forex market. And the impact is not necessarily the same in the Forex market and in the stock market or in the bonds market. So we provide a simplified calendar in which we focus only on the main news, the news which will create movements in the market in case of a big surprise. So this simplified calendar is also freely available. I will not go deeper in the explanation. There is an explanation on the website how to interpret the information given in our news watch list. So, and then we give below the calendar, the news calendar, the list of the best trending pairs. Because never forget that the MAX trading system is a trend following system. And so in order to get nice profit, we need to have trending pairs. And so how to choose the best trending pair? And so we provide every week the best trending pair. We call it the top pairs list, usually containing 10 pairs out from the 28 possible pairs we have using the 8 main currencies. So the US dollar, the yen, the euro, the Swiss, the CAD, the Aussie, the Kiwi, and the pound, of course. And then when we match these pairs from the top pairs list with the previous simplified news release calendar, we provide for every day of the week a suggestion of pairs to monitor in order, in case of big surprise in these news releases, to catch the big movement they may have in these pairs. So for example, when we have updated that week a few weeks ago, that page, so on the Monday, the pair to privilege were the pound US dollar, the euro US dollar, the pound yen, possibly the pound Kiwi, the pound Aussie, and similarly for each day of the week. So, and by the way, our news watch list page will be updated so this weekend, and so I will show you our website in a moment, and so you can access freely to that page, and you can even be informed when the page is updated if you set your name and email address on the page. And then we have an additional very, very important information, which is not free. This information, specific information, so needs a small monthly subscription. We provide for day trading, so we provide the global context, specific global context for the day, which tell us in which direction we have to favor the trade. For example, we follow a certain number of pairs among the major pairs and the best trending pair, plus some stock market indices, plus 2 commodities, gold and crude oil, and also 2 bonds instrument, the US 10-year Treasury bond and the Euro bond, so just to represent the bond market. And we have also an indication on the VIX, which, as you know, is the volatility index of the S&P 500. And for each day, and eventually several times per day, we indicate in which direction to trade. And so when we have up green arrow, this means that the instrument must be traded long. And when we have down red arrow, this indicates that the corresponding instrument must be traded short. And the strength of the directional bias is indicated by the number of arrows. 1 arrow represents a risky bias, 2 arrows represent the normal bias, and 3 arrows represent a strong bias, because sometimes we have a very clear idea of the global context. And so the global context also helps to define so the bias for each day, taking into account what we call the market sentiment. And we have also the same kind of directional bias for long-term trading. For those of you who trade higher time frame, like the 4 hours or higher time frame with the same idea, down red arrow or up arrow, depending on that global context, longer term global context, so analysis. And so now to give you an idea of the performances of the MAX, whether we use or not the global context, so I can give you these numbers in the 5-minute time frame. So many of you are interested by the winning rate. If we do not use the MAX advantage bias to the global context analysis, the MAX trading system has a winning rate between 70 and 75%. Sometimes more, sometimes less, depending on the market conditions, but also depending on the time frame you are using. These numbers are for the 5-minute time frame, but for higher time frame, these winning rate have a tendency to grow, to become larger. But if we use the global context analysis, so the winning rate jumps up to 90-95%. We have less trade, but we have a higher winning rate. And this is true for the max primer or for the max standard. Now, for the max primer, we get between 3 and 5 trades per day when we consider the entire day, so including the Asian session, the European session, and the US session. But it's true that most of the trade will appear during the European and a portion of the US session. But this is the nature of the Forex market. When we have a winning trade with the max primer, the profit will be between half R and 1 R. And a losing trade is around minus 0.5 R, so between minus 0.2 and minus 0.6 most of the time, on average minus 0.5 to 1 or R. With the max standard, so we have the same winning rate, we have less trade per day because we exploit the entire trend within just one trade but with many scale-ins, or as many scale-ins as possible, so we will have between 1 and 3 trades per day. The winning trade on average will be between 2 hours and 5 hours, and the losing trade will have a loss approximately identical to the loss of the max primer, a little larger due to the scaling technique. Because sometimes we can make a scale-in and then the trade reverses and provides a losing trade. And so in this case, the average loss will be a bit larger, but still reasonable. And when you calculate the expectancy, so the expectancy is the winning rate times the average profit minus the losing rate times the losing trade, the average losing trade. And so if you make a calculation for both the max primer and the max standard, you will see that the expectancy is nicely positive. So this is what I wanted to show you about the max, and later in our Q&A session after Chris' presentation, so we will switch on my MetaTrader platform and I will show you some example of what would have been possible, for example, this week. So we will take one instrument and we will scroll for every day of the week. And now, Chris, I give the mic to you for the rest of the presentation.
And okay, so what this thing is all about is money, essentially. What we want to provide you with the max is some sort of income, financial security, money coming in so that you can buffer yourself against external shocks like inflation, like COVID, like being out of work, having to pay for hospital bills, especially in the States. So how we're going to help you get there is by showing you how to assess the risk. We're giving you a whole bunch of high probability entry setups. I went through and roughly counted the number of entry setups for the standard, and there's something like 12 to 15 of them that I was able to count. And there's a slew of exit techniques, more than I can actually count on those ones. The primer itself has 3 entry techniques, so it's a subset of the standard. It's a cut down version. It's still profitable, but you don't get all the goodies with it. We show you how to assess the risk by using what's happening with the price. For instance, long bars is one way of assessing what the risk on that particular entry point would be. Via indicators and with Eusebio's context, both technical context and global context. I won't go into that, that's a whole other session, but if you know what the market is doing, it really helps you become more profitable, as Eusebio was showing. And then we supply you with a whole pile of practice situations, both through homework, and yes, we do have homework, and as well as on the weekends for the practice sessions, and we help you become very precise with your entries and your exits. On the managing risk side of things, one really important piece is the correct order or position sizing. A lot of people will just place a bet of 2 lots or half a lot or something like that and stick with it, but they don't realize that a lot is just a number, and it varies depending the amount that number is worth. The number of dollars depends on what pair it is that you're trading. So a lot for a euro pound is worth much more than a lot for an Aussie Kiwi, an Aussie Kiwi lot. So in some cases, you might think, oh, I've made 100 pips here, and you come out with $50 worth of profit. And in another case, you might make 100 pips on the euro pound, and you come out with $200 worth of profit. So they are different beasties. So you need to be able to correctly have the correct order size so that you don't overtrade, and so that you don't lose out when you do get a good movement going. And on the profit side of things, by using the techniques that are in the Max Standard, by using scaling in or order stacking or reverse pyramiding or reverse martingale, whatever you want to call it, you can boost your profits really well. I know this is going to be a bit contentious with some people, but when you're trading, you can quickly achieve a zero loss situation and even a guaranteed profit when you're trading. So long as you don't get hit with something like a black swan, with the Max, when you're trading with our money management side of things, and especially with the Standard, you can get into a position where there's no way that you can actually lose on the position. So it doesn't happen straight away. After a few bars, it'll be there. And it happens faster with the Standard than it does most times with the primer session. And we have this thing where a lot of people just go for their 10 pips and they've made it, and so they jump out, and we regard those people as being greedy. We want you to be super greedy, so that rather than just going for the 10 pips and saying, yep, I've got my money, we want you to take out the whole movement and show you how to do that, and practice you, give you practice information on how to go for the whole run if you can. So that's where the letting profits runs piece. So the Max method is like, as I was saying, is very nimble. It adapts to the price action. So it depends on, doesn't really matter what mode the price is in, if it's in a trend or a counter trend or a breakout, choppy or counter trend. We still have techniques for actually getting into that and staying out of that particular price mode. Eusebio's work on direction positioning is really great. There's a technical indicator which is made up of two indicators that he showed you. The companion bias at the bottom of the chart gives really good positioning so that you know if you should be going long or short at a particular time. And then coupled with his bias advantage, the subscription service, not trying to sell that, but just sort of saying you can really boost your profit potential and your win rates by using his other bias techniques. In the Standard course, Jim Pruitt, I guess the initial founder of the Max, developed this really amazing dynamic support and resistance indicator, which is almost like trading with the headlights on. So we could almost have just a blank chart with the dynamic support and resistance levels on it, and be able to say, hey, price is probably going to go up to here and then we'll get out, or if it goes to here then we'll get in, kind of thing. So it's very nice and helps clarify what the market is up to. It's also really helpful for knowing when not to get into a market, because you can tell if it's moved too far already and is in a dangerous position and things like that, like to just snap back on you. So, and the really important piece is we try and minimize your risk as much as possible with our money management and trade risk management techniques. So there's a lot of them in the Standard, there's a few of them in the primer, but we are very risk averse here. We want to make the trading as safe as possible for you. We cannot predict what the market's going to do. People run around looking for the Holy Grail and the indicator, and the Holy Grail, I think, is you, but you're still going to get losses. And by having a really good money management setup behind you as a safety net, then you will be able to trade and make a really nice profit out of things. One of the really interesting things with the standard that I find is that as you do more scale-ins, as you add to the orders more and more to make more profit, the risk actually starts to drop off. And I've mentioned before that you get to a zero risk situation, and that zero risk then becomes a negative risk, which is a guaranteed profit. So counterintuitively, the more that you work at making profits, the less risky it becomes. Even if the stop gets hit, even if price slams back against you. The objective feedback that they get really helps. When you're trading when you're trading, it's kind of a lonely exercise, and people will do stuff and they think they've done it correctly, but the market goes against them for some reason, and it's hard to figure out if it was you who made a mistake or if it was the market. And by sending it into a third person like us, we can say, yeah, you did everything correct, but the market's extra spiky at the moment, so maybe loosen your entry tolerance slightly so that you don't get caught by those spikes and then taken out on the next bar, which is what happened to me a couple of years ago when the pound kiwi was jumping around all over the show. So I thought I was doing everything okay, and I had to check with Eusebio. What am I missing here, because I'm losing out on these couple of trades here. So, and with his feedback, we were able to determine that it's the market, it wasn't me. So I adjusted the way I traded, and that's that sort of help that we can provide you. Third person coming in, so that you're not just sitting there on your own, but you have to ask for it. So with the training course, what you get is the full system. You get everything. There's nothing else that's needed. We do have some extra bits and pieces if you did want to purchase them, like a money management tool, and I think that's about it. Sometimes we say, well, no, I think that's about the only other thing that, if you wanted to purchase something, it's not necessary, but whatever, you get the full system with all the indicators, the templates, the examples, and the videos. So there's nothing else to purchase. You get training from a pro, Eusebio, and we don't tell you in these sessions what some of his trades have been capable of, because people wouldn't believe them. So the number of pips are so large and the profit has been so huge. But he is a real pro, and he hasn't had any losing days in the past 7, maybe 8 years now. Okay. Thanks. So the end result is you're going to end up with a system that's got a win rate of something like 65 to 85%, even higher on higher time frames. The reasonable profits you can expect from them is, with the max standard, about 2 to 5 times whatever you risk. So if you're risking $100 on a trade, you can expect to make, well, once you're competent at it, and it's up to you as how long that takes, you can expect to make, on average, about $200 to $500 per trade, with an average drawdown or a loss of about half that. So if you added up all your losses, they'd probably be on average about $50 whenever you had a loss. So the two should be completely different on that side of things. And on the Primus, the standard course has got the profit boosting side of things. The Primer course is just a subset, as I've been saying, but it's only a buy and hold system. We give you all the support that you want. You'll end up with a really powerful method for trading Forex. I haven't actually seen anything that's been as profitable and as safe as the Max on the trend trading side of things. I haven't really gone into some of the other ones that use volume and such, because we can't get that out of the foreign exchange side of things. But the real benefit from all this is that you'll be able to achieve your goals quickly and safely. And safe is the main thing, so that you end up with your the wealth that you need, the independence and the security that you're wanting. Next slide, please, Eusebio. Thanks. So, as Eusebio said, we've got two courses on offer, the Max Standard and the Max Primer. The Standard runs for 7 sessions, and in each of these we also have another bonus session at the end of them. So 7 + 1 sessions for the Standard. Max Primer is 2 sessions. Standard has got multiple entry scenarios, something nearly 15 of them, whereas the Primer has got just 3. Okay, so it's a cut-down version, and the two systems run concurrently to start with. So days 1 and 2, Max Standard and Max Primer will run together, and then Max Standard just continues on for sessions 3, 4, 5, 6, and 7. The Standard has got the profit boosting. Max Primer is profitable, but you don't get the profit boosting out of it. So it takes longer to make some of the big money that is capable from the Standard. And the Standard has got a lot of trade and money management, risk management built into it. The Max Primer is safe. It's got basic money management in it, but it doesn't have all the bells and whistles that the Standard has. So next slide, please, Eusebio. The Primer is essentially a subset of Standard. So the Standard course begins on September the 8th, which is about a couple of weeks away. It's Thursday, meets at 3 p.m. New York time for the 7 weeks. Normal pricing is $3,000. The webinar special, and if you use that link there, and it'll be going up in the chat area, is the webinar special is $2,399. So quite a nice discount on that. Oh, and if you repeat the courses as well, there are massive discounts. And if you repeat them something like 4 times, then there's no charge if you want to keep on attending. And because the market changes all the time and Eusebio keeps tweaking things to adapt to the market, it really does pay to keep on just taking the course just by video if that's all that you want to do. So next slide, please, Eusebio. The same thing regarding the discounts applies to the Primer course. So the Primer is normally, it starts the same day as the Standard, runs for 2 days, first week, second week, and then that's the end of the Primer course. There's enough there to be profitable and start trading with. It's normally $300. The webinar special is $159. And again, if you wanted to retake it, we only do them every few months or so. So there's quite a big gap between the takes. But there's a large discount again, and once you've done them about 4 times, then there's no charge if you want to just keep on getting the videos or attending them, sitting in on them. You don't have to do the homework, that's optional, but we really do recommend it. And next slide, please, Eusebio. Okay, so there are the 2 items there. I'll put the links in the chat area, and they'll be coming up by video as well for taking up the courses. Got some questions here in the room. Question from Michael was, do we use MT4 or MT5? We use MT4, Michael, MetaTrader 4, for our training, simply because it's so ubiquitous. There's, if you look at if you print out the number of brokers using MT4 versus the number of brokers using MT5, MT5 takes up about half a page of A4 of list of brokers. MT4 traders, brokers, take around about 3 or 4 pages, full pages of list of brokers. There's a whole amount, huge amount has gone into MT4 in indicators and trading methods and stuff like that. And to go over to MT5 would be too much of a shift. So that's why it's MT4. All our indicators are MT4. If you want to port them to MT5, we're quite happy to give you the source code. Similarly, if you want to port your code to something else, we're more than happy to give you the source code for it as well once you've done the course, so that you can start trading in that. A lot of people, for instance, on Interactive Brokers, use MetaTrader for their charting platform and then place their orders in Interactive Brokers itself. So you don't have to it's not necessarily an either or. You can have both running at the same time. I hope that answers that question. Desmond has asked, do you recommend any funded trader programs? We don't recommend any brokers or funded traders. Maybe that's also called a prop firm. We don't recommend anything like that. We've seen a lot of brokers that have looked really good and thought, yeah, maybe we will introduce them to our members because they're looking good. And something invariably goes wrong. They're caught with their fingers in the till, or the proprietor runs off with the money or something like that. So no, we don't recommend any brokers.
Chris,
broker that we, yeah. Go for it.
Concerning the funded trader program or prop firm, so you have to know that almost all of them impose very strict conditions, which create stress on the side of the trader, and this is why many traders fail to succeed the test phase or the validation phase. And very few of them so becomes really funded, because this is the business model of this prop firm. And so just to give you two small examples, so you need to achieve some objective, 10% of profit within 20 trading days. You have never a guarantee that you can achieve such a profit in that period of time. And they also impose a very tight drawdown. And if you exceed that drawdown, you have failed the validation or the test phase. And so the conditions are very strict and very stressful. And so, but of course, you can try them if you want. There are plenty of them, and those which exist now are not bad at all. But their conditions are difficult, very difficult.
Okay, thank you. Other questions? Does Max work on TradeStation? We did have some indicators for TradeStation, Dan, back in the early 2010s. I don't know if they still work. Nobody has reported back that they've stopped working. But like I said, if you want to use them on TradeStation, more than happy to give you the source code from MetaTrader. The indicators themselves are reasonably, most of them are pretty standard, straightforward. I think you'll be able to adapt them reasonably easily. So, and a lot of them are already there. Like the moving averages are all standard. The stochastic is a bit tricky. There's generally several of those floating around, so you'll have to find the right one. But we can supply you with all the information that you need to port them across. Okay. And what else? How do I get to watch trading on non-farm payroll? Okay, we'll send a link out to you for the non-farm payroll. Yeah, I'll make sure. If you don't see it, Lionel, within the next few days, just drop us another email and we'll make sure that you get it. Robert. Okay, and okay, that I think that's gone through all the main questions. Oops, sorry, I'm just scrolling down through here. Okay, a couple of other questions that generally are asked are these ones. Sorry, my screen's frozen up here.
We have a specific question by Dan. Does Max work with tick charts? So, and yes, indeed, Dan, with MetaTrader, the standard way to chart a price action is to use time bar chart, but we can define through specific tools. We can create a constant range bar chart, Renko chart, or any variation of the Renko chart, and tick chart also. But you have to understand that with MetaTrader, we don't have, in the Forex market, we don't have the real volume. We have only the tick volume of the broker. And what is the tick volume? It's the number of trades being made. But we don't have the knowledge of the volume of these trades. In the futures market or in the stock market, we have the real volume. So we have also the quantity of the assets being traded. And so this may represent some difficulties, especially with the tick charts. So, okay, or the volume chart, because we can make the distinction between tick and volume charts. which is possible, by the way, with NinjaTrade, because the max trading system works also under NinjaTrader 8. We have the indicators for NinjaTrader 8, and then you can use any of the chart you want to use in the futures market.
Okay, thanks, Eusebio. Yeah, I'm sorry I missed that one. Desmond, I'm not too sure if you've asked me a second time what broker we use. We don't recommend any brokers, so we're not going to say which broker. Being in New Zealand here, I have a completely different broker to everybody else around the place. Australians have their own set of brokers. I was trading with two US brokers, but because US has gone into regulation mode, they don't want a Kiwi trading here because they don't have the required permits to allow New Zealanders to trade with them. So I can't trade with something like Oanda or Forex.com, something like that. Yeah, but there's lots of other brokers out there, and we can supply you with a list of them if you want. And Ralph is saying that Canadians aren't allowed to trade in the US either. Just depends. But okay, sorry, thanks, Desmond. But I said I use one broker for the platform, so the charts all look the same. Yes, for the demo platform, yes, we use one particular broker, but we don't want to promote him as a trading broker because we don't know if he's any good with the money side of things, with the money management, with returning your money or anything like that. We just use that particular broker for the charting platform. Okay. And do you, Michael's asked, do you offer other paid services to people who don't take the course? Well, we've got our free Newswatch and the free levels if you want to grab those. And there's Eusebio's pair bias advantage, which I'll find the link for that and flick it through to you, Michael.
I wanted to show you during this presentation in my PDF, so which were 2 examples of trades this week. So this was the Euro Aussie with the max primer. So 3 trades during the portion of the Asian session just after the Tokyo Open and before the US Open, which has been followed by an important news release preventing us to trade during that period of time. Our rule is to never take a trade in the last hour before the news release. So 3 trades, and it happened they were 3 winning trades. So a first entry with a safe and perfect mo, so here, followed by an MX, followed by XXX, second trade, second exit, partial exit, second final exit, and then third trade, partial exit, final exit, and you see the result. 3 trades, 1 losing trade, 2 winning trade, but a large profit for the combination of these 2 trades. But with the max standard, that same movement has given just 1 trade with more decision, 5 scale-ins, initial entry and 5 scale-ins, 10 partial profit and 1 final exit with the last 2 opportunities. So you can see here a 15.1 R reward to risk ratio, which was almost 5 times so the result of the max primer. So this was a pair. An example of an index, the Dow Jones, so in the futures market is the YM. So before the reversal for the rest of the day, so it was possible to take that nice, that nice short trade, followed by a nice long trade and another short trade. But I have taken the example of the short trade, so 2 trades, which were also 2 winning trades for a total of almost 3 hours profit. So 2 individual trades with the max primer, but with the max standard, that movement alone would have produced only 2 scale-ins, 5 MX and a final exit for a total of 400 points of profit, giving a nice 6.2 R result, which for such a small movement is a nice movement. So, and this is the kind of trade you can make almost every day. So at least if you use a small time frame like the 5 minutes or the 15 minutes. If you use higher time frame, of course, you will have less trade per period, but you will still get very, very nice trades.
So we'll leave this up for about 5 minutes from now and then turn it all off in case you want to ask some questions or something like that in the chat area. But we'll finish the presentation properly now. So thank you very much for your attendance. If you have any questions, please contact us. Have a good weekend. Bye from me.
Keep safe, have a great weekend, and see you either on the next presentation Tuesday or during our open house session, live session with the non-farm payroll. So Friday, the 2nd of September. I will leave the room open for 5 minutes, so see you next time, and in the meantime, take care. Bye everyone.